Thanks for joining us on another For Investors, by Investors South Bay podcast. As always, we are proud to be your all-education real estate investment resource without any kind of sales pitch. If you would like to attend one of our meetings in person, we meet the second Wednesday of the month at The Point in El Segundo. You can RSVP at forinvestorsbyinvestors.com/South Bay. To find more investment resources such as blogs and podcasts from other FIBI groups, go to forinvestorsbyinvestors.com and search our library. Now, on to the podcast.
So, For Investors by Investors, or FIBI, was started by a couple of full-time investors that were tired of the sales pitch each time and wanted to go and find a place that people could go and network and get education about real estate without getting pitched the boot camps and the book and tape sets and, the next upsell of the month. And so at any of our chapters throughout Southern California, you won't see any sales pitch at our events. We have one in Orange County. I run the Long Beach / Cerritos group. We just actually moved it to the Cerritos Library, which, if you guys haven't seen that library, it's absolutely beautiful. And we I'm trying to find out how to be a resident of Cerritos so I can get it for free, but it's not working. So, but
short-term rental.
Yeah, there you go. So look there. That's a great idea right there. So, but anyway, so we have Orange County, we have Pasadena. We're opening one in Culver City pretty soon. Jeff, you want to raise your hand real quick? And Jeff's actually going to be opening one. And Jeff is a full-time investor, just like all of the different chapter leaders. They're either full-time in real estate or a full-time investor. And we just are here to teach because we really love the philosophy and feel like, hey, if we can give back and add value, we'll get all the business we need and we'll get all the relationships we need out of it. And, it's like karma. You go teach as much as you can, and that one person that heard something in the room tells somebody about it, and you get a referral 5 years later, and, that's how it works. But anyway, so hopefully we add some value to you guys in the room. Dave is going to kind of go over some of our sponsors today and a little bit about our chapter here.
Thanks. Well, thanks for braving the parking. It's normally not this bad, but in the summertime, they do these free concerts, and I know it's crazy. So thank you guys we were talking earlier. It's like, I wonder how many people drove around for 15 minutes and just said, oh, screw this, and just drove off. Yeah, thank you. Well, thank you guys for not driving off. We appreciate that. I said because even there's construction next door. You used to be able to park across the street, but now that's under construction as well. So anyway, we'll appreciate you guys coming. As Matt mentioned, we don't do any, there are no investments in FIBI. We get asked all the time, how do I make an investment in FIBI? We're like, that's not who we are. We're all about education. We're all about networking. While there are no investments in FIBI, I can tell you every investment I've ever made, somehow, some way, FIBI's been connected. I either met a member, an investor, a lender, a partner, somehow or another, I've met someone through FIBI that's helped to put that deal together. So, as Matt mentioned, we're going to have a nice educational seminar here tonight. We've got 3 great panelists to talk about notes/debt, and how debt works and affects the real estate deal. And then when we're done here, right across the courtyard here, the concert should be done. We've got the patio rented at North Italia, and then we've got food that we've bought. It's a cash bar. You buy your own drinks, and all of us are going to be at North Italia afterwards. So don't plan on being here and then running off as soon as everyone stops talking. You're missing out on the most important part of FIBI, which is the networking.
There'll be plenty of parking afterwards. Don't worry.
Plenty of parking. Yeah. We are clearly doing this for our, one of the reasons why we do this is, they say the best way to learn something is to teach, right? So it's part of why all of us got involved into FIBI. Actually, Ellis down here is one of the original partners of FIBI. So Ellis and a guy named Jeremy Roll started FIBI about, almost 11 years now. We've been saying 10 probably for 2 years. And one of the things that we are working on is we are working on a 2-day FIBI, it's a 2-day conference that we're going to co-sponsor with another brand looking at Marina Del Rey, and it's going to be the same spirit of what we do on a regular basis, but obviously to a larger scale. So there'll be some information going out. Clearly it's going to be a little more expensive than just coming to a $20, $25 one-night session. But keep your eyes and ears open. It's kind of how we're looking at growing FIBI, taking it to another level, is starting to put together these larger conferences where the same no sales pitch philosophy will exist. So that's one of the things that we have on the horizon. Our group that we're doing next month in August is going to be all on multifamily investing. So if you've got an interest in, everything from kind of small 2 to 4 units to larger multifamily properties, we're going to be spending a lot of time talking about that and how it's relevant in today's market. It's one of the things that we always try to do. It's one thing to talk about notes. Tonight we're going to try to spend time talking about what's it like being a note investor today, this point in the cycle, so you get some more current real-time information from people that are, on the front line on every single day. We do have some sponsors that we want to thank. Actually, first of all, the Note Assistance Program, Jasmine here, this is her company. They're one of our sponsors, so thank you for sponsoring us. We love you as well. We've got Jeff from UDirect back there, self-directed IRAs. So if you guys have any questions on that, always, you can ask Jeff. We've got a new sponsor, Civic. Brian, raise your hand over here. They're a hard money residential, well, actually residential and commercial as well, huh? Mostly multifamily and single family stuff. So thank you guys. Thanks for great to have you aboard on that. Andrew Westling with Walker Dunlop, they're a commercial lender, institutional lender. I don't think he's here. We've got the Spiro Woodward Group. They're a local attorney firm, real estate firm. I don't think Jason's not here tonight as well. So we've got information on all of our sponsors on the back.
New Western.
Oh, New Western, right. New Western is a company that does, they basically are a wholesale company on steroids. So if you're looking to finding rental property or finding property to fix and flip, they specialize, very, very extensive online selection process on finding property. All their information is back there. If you need any resources, we recommend you start there. If you need other resources that aren't one of our sponsors, let us know. Clearly this is our space and we can point you in the right direction. Tonight we have some pre-scripted questions that we'll take you through. Part of FIBI, if this is your first time, is we encourage you to ask questions, right? We're going to try to get to as many questions as we can in the audience. So if you've got a question, please raise your hand. We'll get to it. If you've got a very specific question about your personal situation, save that for North Italia over pizza and a glass of wine, right? It's just going to go across better than having to ask it here anyway. But please feel free, raise your hand. We'll try to get to as many questions as we can. If your question is something that we're going to cover later on in the topic, we just may say, hey, hold that question, and we'll get to that later on. If you do need to get up, we still have food back here. Just, you can kind of walk around the side back through here to get past this door. Try not to go through here because we do have we're on live streaming right now. And same thing, if you have to use the restrooms, they're at the front, feel free to get up. And, we kind of have the table back there. We know some people have a hard time sitting still for 2 hours. So if you got to get up and, feel free to stand up and walk in the back. So with that, there's one last thing. Matt and I have been running this group together for about 6 years. And for years, Matt's always been kind of the cool, young, hip, young guy. And I have been kind of the old guy, right? Well, Matt actually turns 40 this weekend. Yeah. Which means for the next 8 months, Matt and I are both going to be in our 40s. So every 10 years for 8 months, we're going to be kind of the same age. So welcome to being another old guy, Matt.
I'm going to age a lot faster than you are. So,
That's right. Yes. That's right. So anyway, happy birthday. Enjoy celebrating. He's also a new dad, just had a little baby girl. So he's got quite a bit going on. Yep. Which is great because he's a terrible CPA, so it's good that he's got his family happening. It's a much better use of your time.
That's the guy that asks me for all the tax advice, but then every once in a while I'll call him, hey, what is this? I got this tax question, Dave. He's like, why the hell are you calling me for?
Yeah. Yeah. Matt calls me and asks me questions on taxes. I'm like, dude, you're the CPA. What are you asking me for?
Self-directed IRA question. You know everything about that stuff. It's great. So.
Fun stuff. All right, so we're going to launch into it. So we're going to start off with each of you guys kind of give us like a 3 to 4 minute introduction on who you are. And Brett, why don't you go first?
Hi there. Thanks for having me, guys. I've only been to a few of these, so I feel honored to be asked to speak. I am a 29-year career as a mortgage broker. Which makes me in my 50s. So that's my day job. I work in predominantly residential mortgage finance. I manage a local company called RPM Mortgage, or Caliber Home Loans. I was at RPM Mortgage, so excuse me. And what means we just do traditional residential finance, and that's my day job. And then why I think I'm being asked as a speaker is on the side, I do about 30% of my business is multifamily and commercial lending, and of that 30%, about half of it is sliced up in privately held notes, bridge loan notes, hard money notes, second trust deeds, third trust deeds, owner-occupied, hard money notes, all the full gamut of different type of note origination that we do to facilitate what might be a normal deal that people didn't even come to me that needed that type of money. And then on my spare time, I'm a note investor. So I've invested in notes for, I got in the business 28 years ago, and my best friend, instead of going into a paper mortgage business, he went into the private money. And so I've been investing with him for over 20 years now. So I love it. It's kind of a hobby. They're exciting. I've been through cycles when we've had downturns. I only took back one property in 22 years. Excuse me. That note paid me 13.5% for 9 years before I took it back. So even though I lost 100% of my investment, I made more than I invested. So I've never lost money in notes, so not too many people can say that. And I enjoy real estate. I brought a friend here tonight who's a young guy in real estate. I'm just excited about it. My son, I have a 10-year-old and a 19-year-old. My daughter has 19-year-old has no interest in real estate other than inheriting it one day. But my son today, for the very first time, he heard me. I'm doing a deal on a Walgreens, probably with Andrew Westling, your sponsor here. And he heard me talking numbers, and he goes, I think I'd be really good at your job. He goes, I just want a job where I can do math like that. And then I explained to him cap rate. Now, could a 10-year-old get cap rate? I guarantee you my son understands it. So it was the first time, other than about 3 years ago when he was sitting in the back seat of the car with about $500 of quarters on his lap, where he said, this is a pain, why do you own these buildings? And then we're driving away and he says, wait a minute, do you get to keep all these quarters? I'm like, yeah. He goes, yeah, I want to own apartment buildings. So anyways, I love this business, I love notes, I love lending. Thanks for having me.
Well, you should bring them. We clearly have a young youth section growing here at FIBI. We've got a 7 and an 8-year-old. Actually, Christina Suter back here, who just waved, is one of our Pasadena chapter leaders. So if you're interested in going up to her group, go talk to her afterwards and get more information. Brett's one of these lenders that when we've got a situation where I'm not quite sure if it's private money or institutional money on who's going to take that deal down, he's one of the guys that we call on that. So thanks for being a part of it. Jasmine, why don't you tell us a little bit about yourself?
Definitely. Well, thank you, gentlemen, for having me. Happy birthday, and I can't wait to see the new daughter edition. We are twins. I have a 9-year-old and a 19-year-old, so I was like, oh my goodness, the gap is real, right? But giddy up, everybody. How you doing? This is Jasmine, right? You guys doing all right? Yeah. Okay, because I'm the one that needs the energy. Yeah. Just to be clear, the energy goes below here. I kind of got to leave. Okay. So what do? I run something called the Note Assistance Program, and the cowboy hat is because I do all the stuff no one else wants to do. I buy dirty paper. If there's any mortgages that has not been paid for 10 years or plus, 6 years, I'll buy it. Okay? So he does a lot of originating. After the originating is done, and after everyone can tell who's who, either a good borrower or not borrower, that's when I jump in, right? And so I also buy and sell performing notes. So whether you know it or not, even if you're paying your mortgage, I can buy it. And so that's what I teach people, right? You're going to find that there's a very healthy market for people looking for double-digit returns that you can get a good handle on. So that's why I teach people how to write it. But I come in from the other end, right? So this is the danger over here, right? We come in, we're buying dirty houses, dilapidated mobile homes. How many of you are part of the Note Assistance Program, just by the show of hands?
Yeah.
Okay, so these are the crazies in the room. Go and talk to them, okay? Because you need to know what it's like to be over here. When Jasmine tells you to buy a dilapidated mobile home on 2 acres in North Carolina and you've never been there before? Right, that's the look on your face right there. So, with that said, performing notes, non-performing notes. Non-performing notes is how I got my reputation. I'm going to the bank saying, give me the junk. And they are so happy that someone is responsible enough to get it and not hurt themselves, right? And so I'm buying all the dirt, and what I like to tell you is I have anywhere between $35 to $55 million worth of unpaid balance on my trade desk in any given month. So, for those of you who are my members, you know, and you can ask them, by the 5th of every month, you're going to get a tape, right, that has at least $35 million to $55 million. Can I get an amen? Someone? Amen. Okay, you get that in your email, and then you get to go to your pajamas and roll to there and scroll nationwide and see who's not paying their mortgage. If you want performing notes, you can ask me, I'll tell you who is paying their mortgage, and I can tell you how much you can buy that for, right? So my background real quickly is I have a degree in economics, and then also industrial organization, right? So I'm really focused on like corporations and what they do. My first job was on Wall Street. I was a day trader during the dot-com era, right? So I have this real uncanny ability to like work with bankers, talk with bankers, and snatch a deal. So that's really what I've learned to do. And so what you're going to get at my trade desk or with my program is the ability to learn that vernacular, right, and learn how to deal and get that deal done with the banks and work that asset, because it's not what you think. If you're a flipper, it's the opposite hat. And it takes me a lot longer to get through to your head, right? So match one of my clients there. You can ask him too. He'll give you the skinny on what it's like. But at first it's a little treacherous, but we make good returns. That's what we're here to do. I've got Natasha in the background. Just to say hello to her. She works for us. I want you to have an opportunity to say hello to her as well. But that's about it. You can find us at noteassistanceprogram.com.
Cool. Thank you, and thank you for sponsoring FIBI. We appreciate it. Ellis.
Hi, everyone. Can't follow that. That's a lot of energy right there. I've been investing since the late 80s in properties, and then I learned about notes in about 2001 when I was having a hard time buying properties. I buy both property and notes. I buy, sell, and create notes. So I create notes in order to buy property so that I don't have to use a bank. I love the real estate game, and I think that understanding liens and notes is just a natural thing to gravitate to make yourself a much more savvy and sophisticated investor. There's many times when I can look at a deal and create a profit when no one else can actually see it. And that's been a lot of fun to learn. And the best thing about this is that I learn stuff all the time, and I'm actually learning a lot about how to fix title issues and things like that with notes, and it's actually very, very complicated but profitable. But it's the way to set yourself out as valuable versus all the other people that are doing kind of the same thing. It gets really hard to compete because we all know how hard it is to find properties right now, right? So I've been doing this for a long time, but I appreciate you guys coming here to listen to all the wisdom here on the panel.
Thank you very much. Kids, shh. Love kids. No, it's totally fine. So it's when they get together, So trust me, I have my 3-year-old runs around with a Thor hammer and Maui's hook banging right next to my newborn's head. I'm going, freaking out. So trust me, I know how it is. And let me try to bring some more energy than Natasha here. I'm going to stand up. No, I'm just kidding. So I'm a CPA and a full-time real estate investor, and we basically I flip properties for a living. I flip about 5 to 10 a month. I've been doing it for 10 years. We do a lot of value-add multifamilies. We do a lot of private lending in different markets around the country. We raise capital for syndications. We have a short-term rental business. I invest a lot with Natasha and Jasmine, and I have to tell you, the communication has been impeccable. I love not having to do the work, for those things. Yeah, I know. Hey, JV partnerships are amazing, so I'm telling you, but there's some great strategies out there on the note side, and and then I run FIBI with Dave and Ellis and Jeremy, and it's really just an amazing business to get involved with. And the more you realize that it's all about the people that you're working with, and and the different relationships and the resources they have and their skill sets that, people have skills and resources they don't even realize they have, whether it's time or money or knowledge base or finding deals or, there's a ton of different ways to do things. There's people that just know how to analyze stuff. It's a huge skill set. It's not easy to find. There's people that just have tons of time that can go in and kick butt and get things done and make everybody money involved in that process. But a lot of, it's about teaching people how to do it, and it's really, really cool down the line when you start to be able to find ways of helping people that are hungry and want to do stuff. So keep that in mind. It's all about the relationship. Everyone here has a value in one way, shape, or form, whether they know what it is yet. People might be in here, broke completely with thinking I work 800 hours a week and I can't get out and I'm stuck. But it's that one relationship to that one rich uncle or that friend or, that one relationship with someone that finds a deal that has a resource to find good deals or something that gets you in that game. And the more you network, the more you'll get there. So I suggest going to as many networking events as you can in the beginning, or even if you're seasoned, just to keep developing resources.
Yeah, that's kind of how we all got started. Is we all started networking and finding people, and then things kind of grow from there. So my name is David Coe. I am a realtor. This is actually my office, Keller Williams South Bay. Here is our home hub. That's my day job is residential sales here in the South Bay. My hobby, is that how you put it? I am also an investor. I'm involved in a new construction project up in North Hollywood. We're building 37 small lot subdivision homes. I run a couple of funds. One of them is a non-performing note fund where we're buying non-performing seconds and helping to rehab the note, which I'm sure she's going to talk a lot about that tonight. Rehabbing a note can be complicated. You've got title issues and things like that, but you don't have to spend a bunch of money on paint and carpet. It's a different kind of rehab, and we'll talk a lot about that tonight. We are excited to have you guys here. The reason why we all do this is just to build relationships. So if you have an interest in talking more with any of us, come after the meeting, let's exchange some cards, and we'll find a time to talk offline. So, all right, let's jump into it. And Ellis, I'm going to actually go with you first on this one. Just talk about first, what is a note, and what are some of the critical pieces that make up a note? What are some of the documents that make it a note, and more importantly, how is that note secured against real property?
Okay, well, there are secured notes and unsecured notes. We are basically talking about secured notes that are there's a note and then there's an instrument, whether it's a deed of trust or mortgage, that secures that note or the collateral. And when you're buying an existing note, there's also what they call a collateral file that has payment history and any information about the borrower. But basically the two main documents in a note is the actual promissory note itself and then a mortgage or trust deed.
And then, Jasmine, I know you were talking about performing versus non-performing note. Kind of talk about how those are different beyond the fact that someone's not paying. As an investor, those are radically different investment vehicles. Talk about how they're different.
Yeah, no problem. Thanks for asking. I guess I want to start off by saying that they all start off the same, right? They start off with someone originating in good faith, right? We want to get a loan. So the first thing I want to say before I get too deep into it is that there are people behind these loans, right? So we're all talking about it as an investment, but really one of the things I'm particular about is understanding that there are people. These are homes that we're foreclosing on, right? And so you got to keep that in mind. Performing note, non-performing note is just a matter of whether that homeowner, I can tell you right now, had a catastrophe in their life or not, right? I've got performing notes in good neighborhoods. I can tell you one of my favorite neighborhoods in Laguna, right? It's notorious for every time the market turns, every realtor loses their house. Every realtor out there. Me and my banker friends joke about it every time because they go out there and they leverage themselves and they're the main ones at the forefront, but they can't see it coming.
They don't lose their Lamborghinis too, do they?
Well, yeah.
Oh, those poor people.
So they come in.
Keep those and foreclose on the house. They keep the Lamborghini and the girlfriend and foreclose on the house.
Second girlfriend, not the first one. So, to be clear. So they come in all shapes and sizes all over across the nation. Everyone has them, right? No matter what nationality, it's about your financial situation. Okay? And so that's the first thing you want to understand. Performing note is going to have pretty much the same documents that he's mentioned. The only thing I would like to bring up that a lot of people do not is that there are a lot of different types of paper, right? There's mortgages. That's really what he was talking about. There's also contract for deeds. land contracts. And you guys should really be writing this down because you rarely hear about this. Most people only talk about the mortgages, okay? So contract for deeds are the other things, and land contracts, okay? Those, you're going to have an additional piece of paper, right? You're going to have the promissory note, the deed, and probably a quitclaim deed, right? And the launch, right? As well, to transfer it. So you got to understand that there's a lot of different type of paper out there, and all of those you have access to. If you only pigeoned into, I only buy mortgages from banks, then you're leaving out the hedge funds. Those guys buy tremendous stuff from Fannie Mae all day, right? And so the paper itself, just to wrap up the question, performing, non-performing, is just about whether they're making a payment or not. A lot of times you can find a performing note that doesn't look good on the outside. They're not taking care of it. Typically, a performing note's going to have, some curb appeal to it, right? People are taking care of it because a person without any money can't keep up the home, right? It's hard to fix a roof when you literally can't pay your mortgage. So you're going to expect the common stuff with a non-performing note, but it's not always a rule of thumb.
And then, Brett, you are both a note investor and a property investor. Talk about the differences and what you like about being a note investor and maybe how it's different than being a property owner.
First of all, I have a confession to make. I've never once before tonight ever said I invested in notes because I've always said I invest in trust deeds. So maybe I've been saying it wrong all along. The type of notes that I buy are they haven't been originated yet. So it's a file that's been underwritten. If it's an owner-occupied property, we verify their income, their assets, and their credit. If it's an investment property, the only thing we've done is we've reviewed their title, we've reviewed their exit strategy, and we've reviewed the appraisal. And then we fund the deal. We put the money in, we fund it, and my name is on the deed of trust. So I've always said I invest in trust deeds. I've never used the word notes before tonight. So I guess I'm still on the note as well.
You're a noter.
So I like them because I feel like it's a great diversification. When I first started investing in them, I was praying that I was going to take some properties back. I thought I'm going to lend $100,000 second on a property with a $300,000 first, and it was the people were going to walk, and I was going to take it back and rehab it and flip it. I thought that's what I was doing, and I had some people miss payments. I collected late fees, but I never got to take a property back until after the last bubble. And that one, I was in third position and gave it to the guy who was in second position.
Was it a realtor in Newport?
So I like it because an interesting strategy. When I bought my house in Manhattan Beach, I came up with a strategy that if I put $300,000 in trust deeds and was earning an average of 9.5%, and I let that money accrue. This was in lieu of putting an extra $300,000 down. That $300,000 was going to reach $1.1 million at 11 years when my 10-year note was going to convert to a variable, and I'd pay my house off in full. So it was a strategy I used to grow money and compound. Unfortunately, the real estate business went bad, which means I'm in the mortgage business. My income went down, and I started living off some of that note income, and I wasn't letting it compound because it's paid as simple interest. It's not compounding like money in the stock market. So to me, it's just a diversification strategy. I have my money in the market, I have money in my investment properties, and then I have money in notes. And soon I will have money in self-directed. I will convert my SEP IRA to self-directed and let that money compound. It doesn't exactly compound, but every time it grows another 25, I can buy another deal.
It's an interesting point. It's not one of the things that we're actually going to talk about tonight, but everything we're going to talk about tonight, you can do in a self-directed IRA, and a self-directed IRA is a great kind of account to own debt on because it's simple, it's clean, there's not a lot of moving parts. As far as I know notes may sound very exotic, they're actually very simple. It's a lot less simple than buying real property. So yeah, if you want to get some more information about stuff tonight, talk to Jeff afterwards because we had a question.
Yes, I just had a question. This is my first meeting, so I didn't know how much of this is recorded, minutes taken, or anything like that, or should I just be...
It's all recorded on Facebook live stream, but at the same time, we have the audio recording that we can have for later, but at the same time,
The audio recording's on the FIBI website.
Actually, the Facebook live stream will be on the FIBI Facebook page tomorrow, so you can get a copy of that tonight.
So I can focus more on listening.
Yep. Yeah. Jot the high level.
I know.
Right. Well, write down the high level stuff, because it is a 2-hour Facebook stream that you may not want to go back and rewatch. So, one of the things that I talk about on notes is that I like the fact that holding paper is just so much cleaner. Right. You don't have calls because the water heater broke when you own a note. You don't have leaky roofs when you own a note. There is something about you're still exposed and you're still secured by that piece of property, but you don't have the responsibility of the property if something were to go wrong with it. So, I mean, Jasmine, you already talked a little bit about non-performing versus performing notes. What is it you look for when you're buying a non-performing note that might be different versus when you're looking to buy a performing note?
Oh, that's night and day. Can I tell you what my favorite thing about notes are? Real quick. No escrow. I literally do deals while you guys are sleeping and no one knows about it. Period. Amen. I had not done a regular traditional deal in the longest time, and so one of my friends called, wanted to buy a house for me. I said, fine, I'll sell it to him. Okay, 45-day close escrow. They wanted me to send in paperwork for signature deposit. I do my deals. No one knows. One day I got a phone call, and that same house I sold, I think it was your house as a matter of fact, and the city of Minnesota called me and said, excuse me, Jasmine. I said, yes. Do you know anything about this asset that was just sold? I said, yes, I actually sold it to this guy. Well, one day after you bought it, you sold it, and we need to know what's going on. I said, oh, wow, this is great. What's going on is that I live in California. He's like, both of you guys live in California. Literally, he grilled me. And so I was just like, and this is why I don't know. I know.
Who is this again?
It was one of the city inspectors. Guys want to see how they can tax us. Upset because you and I in California making money off the house he drives by every day trying to make money off of, right? And so my favorite part of this is no escrow. You literally get to open and close deals all day and no one knows. You can be sleeping right now and I probably traded your note, Elizabeth, 3 times. He's like, wake up. I was like, what happened?
That's awesome. That's awesome. And that's actually, a very clean way to do it. A lot of times when you just want to get it done and cut a bunch of costs out, because every time you do a flip, every time you move transactions, you got a bunch of closing costs every time, and that does add up on every deal. I mean, it's a couple grand purchase and sell every deal, at least in the Midwest. Out here in California, it's a lot more than a couple grand. But so you're talking about 10 maybe, something like that. So, but it's interesting because from the simplistic standpoint, notes are really simple. I mean, from understanding them, you're buying a contract. There's a lot of provisions in there that make them not simple.
I was going to say, I kind of disagree that they appear simple, but you can make them very sophisticated.
Yeah, well, yeah.
And you can make them do a lot of things that can give you a lot of control. So, yes and no.
From a standpoint with regard to understanding the concepts of this, you're buying a contract and you have a piece of property that is collateral of that contract. That's really what I mean by simplistic. In reality, when you're looking at all the details of the note, there's like a million things you need to pay attention to, just like if you're buying a property to protect yourself. It's huge.
And if I may, just to both your points, it's only as complicated as it makes. A contract is a blank sheet of paper. So, yes, it's complicated. No, it's not complicated. Because, period, we know why it's not complicated to me, because I have you just have to read it.
Yeah.
You need to read it, know what it says, and then you follow those rules.
Yeah, understand the provisions.
If you don't like reading, this is probably not the place for you.
Right.
Or hire an attorney who will do the reading for you, and then you call them like I do and say, so what did the contract say?
and make sure you have a good attorney that knows how to read the contracts right. And lending understands the lending laws and things like that. Right. In that market, right? Yeah, and it's interesting because from the perspective of understanding the paperwork. I mean, you need to understand those provisions. You need to understand that paperwork. If you don't understand it, you have to get educated before you go invest in notes. Because if you don't, then just like Ellis is saying, there's a million little things that could cause that. Do you know every provision and what it means in the promissory note and what normal is? Do you know whether it's a a judicial or non-judicial foreclosure state, which changes your foreclosure laws? Do you know what the provisions and the detail of your deed of trust are, and what issues you have there, or if it's a mortgage or not? There's a million little nuances like that you learn over time, right? So it's simple in understanding, but in reality, when it comes to the actual paperwork, you need to understand that paperwork or have somebody that does. Otherwise, you have no business doing it. So Ellis, what do you think? When you're investing in some of these, obviously you do this for a living and you think it's awesome. So buying non-performing paper versus performing paper, and property versus paper. What do you think? What are the main reasons why you do what you do on the non-performing side? What are the benefits of non-performing paper in comparison to performing and property?
Well, it's all about individual deals. So, just because something's non-performing doesn't mean it's a deal.
Right.
It gives you an opportunity to most likely buy it at a deeper discount than you would a performing note in most cases. Many times with a performing note, you're making whatever the face amount of yield is or whatever the discount you bought it at, and it's performing. With a non-performing note, there's many, many ways to kind of create profit from it. And that's why I kind of prefer that over some other notes, is because you're basically given a blank piece of paper where you talk to a borrower and say, okay, how can we make this work? We can change the terms of the loan. We can say, hey, why don't you pay me X amount up front, and then we'll change your payment to a little bit of this amount. We could put a bigger payment at the end. We could do so many things to solve a problem that it really kind of feeds my need to be creative and not just kind of do the humdrum everyday stuff. So
you can be creative and have a lot of exit strategies.
You can have a lot of exit strategies, and you can make a very good return as well.
I think Jasmine said she had 72 or something like that exit strategies at some point. She's like
15 to 20.
Okay, sorry. I was like, there was like 70 or something. So, Brett, you got.
I just had a question about that. Do you think theoretically, in the event of another housing bubble, or look back at the last one, had the banks treated their notes like the smaller company, not these people who are they're not holding hundreds of millions or billions of dollars in notes, had done a much easier restructuring for these customers, or let people like you do them, that perhaps we would have had a much softer landing? Is that even possible?
I mean, we could always kind of play, devil's advocate, and looking back, I think that there were plenty of opportunities for the banks to do that, but that was kind of a different world, because it was about securitization. It wasn't about banks holding assets. It was, let's write this loan and then send it to Wall Street, and nobody really had ownership of it where they could go to the borrower and say, hey, let's work it out. So the universe hates a vacuum, so people like me showed up and said, well, I'll buy that junk, and Jasmine showed up like, we'll buy the dirty paper, we'll buy all that stuff, and we'll figure it out. Because if you think about the manpower required to negotiate all that, I don't know if the institutions had the wherewithal or the patience to do that. So they just said,
I was just going to speak to that a little bit as someone who was actually on Wall Street during the times, right? You got to understand there's a compartment for everybody, right? First and foremost, none of these banks at any reason are interested in doing what we do, especially for houses 50,000 and below.
It's not set up to do it.
Yeah. And so at some point when I was going through this, because I didn't realize what I was going through until later, you look back, right? And I realized I worked for GMAC Homecomings, right? I was servicing them. They were born out of the need. They woke up one day, the bank said, there's so much money in servicing. So they want to keep all the good ones, the California ones, the Hawaii, so they now are in it, right? And they hold on those. But the rest of them, they're going to get rid of because of the liability involved, right? And trust me, just like you, they make all the money on the front end. So they don't care. As soon as they originate it, they're calling someone to sell it to the secondary market so they can get that money back out there and keep originating. So when I talk to these bankers, they have no interest of whatsoever, except the big ones, the California ones. Those guys, I got to go and wrestle from them, right? They're telling me I got to go sit through dinner with them, the whole nine to get a California asset. But everything else in between, it has a price tag on it. Performing, non-performing, because they're bankers, they want to be liquid so they can go and reinvest. That's the simplest way I can put it. They have no desire. Lastly, I just want to say is that everybody has their place. So I think what's going to happen now is these guys are going to finally just settle down and just do the originating, right? Then they're going to have the smaller banks that are now coming in. They went from 19% originating to now to 50%, thanks to the relaxing of Dodd-Frank, right? Smaller banks are going to come in, take that role as well. And then people like me, people like you, they're going to start giving credence to what we're doing because they are getting in trouble. I don't know if you've seen Harbor, Financial lately, Vision, all the bigger guys. They're getting sued up the butts in Georgia right now. My attorney's like, oh, before we do anything with their paper, let's wait to see, you know. So they're getting in trouble right now, and the best thing for them to do is say, hey, we have guys like you, we have guys like you.
I mean, the biggest thing here is, I mean, look at the model here. You're getting, as a bank, you're getting profitability from originating. You don't own it anymore. So how many times have you taken care of something that you don't own, right? So yeah, we're going to have another bubble. We're going to have another crash. I don't know when, but it's just the nature of the beast now because as soon as they get paid, they don't care anymore. In the old days, the bank would hold the paper, you know, from year 1 to year 30. And they knew the borrower. Those days are gone, right? That's not gonna come back again. So yeah, it'll happen again, and you know we'll be here waiting, right?
It's interesting because there's a lot of, you know, you go through these cycles. It's like the same thing on the lending side. On, you know, people are tighter now on the lending, and we'll see what happens with this next go around. I mean, there's still going to be a downturn, and they're starting to not learn their lessons all over again by coming out with the paper. What happens is they forget that, you know, 10 years ago there was a giant crash, and all of a sudden they start doing the 100% down loans again, and the seconds and the variables and everything all over again. You know, they just do it in a different format. But my understanding is they're doing a lot with bonds right now, and things are going to be really...
Wall Street, and you can corroborate this, Wall Street is infamous for changing the name of something so it doesn't sound as horrible as it is.
It's the same thing, but it's...
Right, yeah. So they'll just change the name of it, you know.
And you used to do stock trading too, right?
Well, that can't hurt you, right?
You used to do stock trading too, right? Yeah, so you guys, I was like, you guys are just exactly the same. So we had a question over here?
Yeah, when you say that you're making the money from the originating, or the banks are making money from the origination, is that just from like origination fees? Like, where else are you?
So how are the banks making money specifically? Origination fees?
Servicing.
They can sell it for a premium too.
And yes, it's called service release premium. So if they originate it and they service it, then they hope to make their money long-term on servicing. If they originate it and then they sell it off, there's another bubble, there's another little fee that they make in there to sell off the servicing.
You guys understand?
Like the yield spread, basically.
Yeah, and I was going to say, also understand, just think of how many times they're making money. Okay, they're going to sit there, they're going to originate it, then they're going to get points on the interest, right? And then as soon as they also have insurance, just so you know, they get paid that way. And then as soon as they're done taking all the money on the front end, they're going to call me and sell it. Performing notes go, especially California, par or above. Okay, so they literally just underwrote the note for $1 million, and I'm going to pay them $1.5 million, right, or a little above that. So the money they make hand over foot. There's a reason there's a bank on every corner, right? And so they are. I just watched this one, and I'll try to send it to you guys. But there's this one demonstration of how much money one loan can make, and once it's originated, and they followed it around for the life of it, and made every loan at least $1 million in revenues. So, you know, they can leave some of that on the table.
That's awesome. Question here.
How much of that junk paper is still available?
Tons.
How much of the junk paper is still available was the question? You said tons.
Yeah, tons. I mean, Aquin's paper is still floating around. That's some of the stuff I love because no one will touch it, right? And they were probably the most hideous people out there, right? So you just got to find it.
You're saying old Aquin loans or new ones?
Oh, because they're out there doing new ones too. I was almost floored.
The difference I'm seeing now is that there's always going to be junk paper, but it's the pricing. The pricing is getting much more competitive now because everybody they're chasing notes. They're like, oh, here's the great new thing, right? So the challenge is buying good value when you find notes, right?
Yeah, those notes were 30-year notes, right? So those are still lingering around for a while, and they may not have been solved. There may still be distress somehow, some way.
Title issues. They're sitting there with no roof, right?
Yeah, well, one of the things because we know we're talking a little bit about the market cycle here is like one of the good things about holding even distressed paper is that if you own a distressed piece of property and the market crashes, you still have taxes to pay, you still have maintenance to pay, you might even have a loan on the property that you're paying, you still have a lot of expense, and you might have a hard time actually finding a tenant to stay in your property. If you own a piece of paper, there really aren't any costs to hold a note during a recession. recession, you could almost put it in a drawer and forget about
That's
it.
what they do. A lot of the banks do. I mean, you do have to pay taxes, right? There's two things we got to do, right?
Well, you have to pay taxes if the homeowner isn't paying the taxes.
Right. So if it's gone, then you're the responsibility, right? You're the responsible one. So banks are supposed to be the responsible ones if the homeowner walks away, and that's really where we get it in the gut, right? If we don't mow the lawns, right? They will eventually try to find you as a bank and say, hey, So there are a few things where you calculate for that, and that's what we teach you at the program. It's just if you approach a note and realize what's going to come in advance and prepare for it, then you're fine.
And Jasmine's talking about she does a weekend class on notes called the Note Lab that I was able to go to a piece of that I thought was ridiculously valuable, and it goes over all the paperwork and everything else, which, like, if you're going to invest in notes, it's something to learn, So whether you do it through Jasmine's course, which I feel is valuable, or on your own, definitely, or through an attorney's advice and things like that, you're going to pay for it one way or another, So, Brett, when you're investing in notes in this type of stuff, or you're underwriting any deal for prospective borrower or something like that, what are the main things you're looking at to protect yourself or your lender or something like that when you're dealing with financing? What are the things you're looking at on the property? What are the things you're looking at with the whole situation is going to protect you as the note investor or your investor that's the note investor?
The main thing that I look at, the obvious, is loan to value, and it's
not always as obvious. Trust me.
Right. So if it's a phenomenally low loan to value, I really don't care about their credit at that point. But I always look at exit strategy as well, because if they stop paying me, maybe they stop paying the first as well. So I'm now responsible for any senior liens. I generally, by the way, invest in second trust deeds. That's why I talk about senior liens. Occasionally, I even invest in third trust deeds. So I always have to look at it like, am I capable, if this goes bad, to keep and maintain the first and the second trustees ahead of me? So I'll never... I shouldn't say never, because I tried to invest in one last week. It was a client. We were doing the first mortgage for $2.6 million, and he needed another 100. Now, no smart trustee or note holder is going to lend 100 behind 2.6. But I raised my hand and said, I'll do it, because I underwrote the file. I mean, we're funding the 2.6. The guy makes about $7 million a year. He could pay. It was stupid that he had to borrow the 100. He had about $3 million in the bank, but the underwriter wouldn't allow him to touch the $3 million. So I was going to do it. So in that case, that's an unusual circumstance.
What kind of rate and term did you get? Was that a third position you said, or second? That was second
position.
So what kind of rate and term is that on the second on that kind of deal?
12.5%.
Okay.
Owner occupied, 20-year term.
20-year term.
We have to write on owner occupied. We write as a 20-year
the longer term because of that. Mm-hmm. See, and that's another hairy situation with the owner-occupied aspect, underwriting it. And, when I do lending, I only do it to other flippers when I'm lending my money out to them because of, the rules and regulations with lending to homeowners. So, Brett knows that stuff and so can work with it and make it happen, and it's a lot more difficult. I mean, you can do it in different markets and things like that, and the SAFE Act and Dodd-Frank allow you to do a certain number in each market, and each state is different and stuff like that. But, if you're buying the non-performing paper or performing paper from someone, then you're okay. You're not underwriting that transaction. You're not originating that transaction. But if you're actually going through and doing the underwriting and doing the loan to the homeowner and themselves, there's a totally different metric of law when you're dealing with homeowner loans versus investor loans. So, and that's something to pay attention to.
Yeah, I'm in the upfront before they're bad, before they're servicing, so I get to see. Usually, I can make a decision on it within just a few minutes.
And what do you get on your as far as rates and stuff like that from your last deal, say on your third or something like that in third position?
The rates are anywhere from about 8.9 to around 10.75% as well.
Okay, cool. And it's interesting to understand the different scenarios from the upfront aspect versus the hard money aspect. When you're doing traditional loans on first in California, you're looking at like anywhere now from 8.5 to 12, depending on the professional lender, and a point to 3 or 4 points. It depends on how professional you are, what your financial situation is, the deal, how much experience you have, all of that kind of stuff. stuff. On seconds, in the, how here in California or in the Midwest, I mean, they can be 15-3, 15-2. They can be higher than that in some cases. Just depends on what you're able to negotiate and your experience and what the size of the deal is. In California, the rates are lower because you're talking about the size of a deal being $500,000 or more, or some big amount. Out in the Midwest, you're talking about $50,000, $100,000, $200,000 deals. You got to make more to make the same amount of money for the effort. So Jasmine, and I'll get to you in a sec, Ellis. Jasmine, when you're looking at these types of deals on the non-performing side, what are the main metrics of the property and the note that you're looking at to protect yourself? Like just bullet point type mentality, and then what kind of rates and returns? I know they can be all over the place, but like, what's typical for you to want to buy a deal? Like what's the? I mean, you're a professional, so yours is going to be like way higher than everybody else. But like at the same time, there's usually a gauge, right? Like if I make X amount, I'm usually cool with that type of deal. I guess it depends on how much you put up too, right? So.
Well, no, I mean, that's a great question, and thanks again. So I spent the last 3 days in Minnesota with this gentleman back there, Peter, and we were just checking out a new landscape for notes, right? And so what I look for when I'm looking at a non-performing note, it's completely different than a performing note. With a non-performing note, I'm really, when I buy it, before I look at it, I'm convinced that the worst case scenario, I'm starting right there, okay? They're never going to show up. I'm going to be stuck fixing it, and I start from there. If you start from the worst case scenario, everything else gets great, right? So first thing I'm going to look at is I want to know what condition the house is in, because I'm assuming I'm going to take that thing down, right? And so at that point, I'm just doing back. If you're a flipper and you can actually get into the note game, you're going to do wonders, because the way I teach you is to think of it, again, from the reverse way. So if you can come at it from the, hey, what's going to happen if worst case scenario happens? Everything else in between there is going to be profit. Okay? And so if you can make money at the worst case scenario, and what does that look like? Double digits. I really don't like saying it out loud because people either think I'm lying or whatever, right? So what I tell you to do is you set your own parameter. You should not use my parameter, right? You should not use this guy's parameter. You set what's comfortable to you, right? If you're making 8% now, you know what you're making. Don't walk into my office saying I want 22% every time. Did I just sell a performing note to someone for 22%? Yes, I did. Is that guaranteed to everybody in here? No, it's not. Right? So I'd really hesitant. If you walk into my office saying, I want a 22% return, that's it, I'm going to show you the door. That doesn't make sense. That's greedy. That's greed. Right? So for me, I set a range. Right? Personally, my range is, and I pretty much will take, I take almost anything, right? It's because there's not much work in it. So, I've taken stuff down as 8%. I'll throw it in my health savings account. You can put these in your health savings account. Again, talk to Jeff back there, you direct IRA. Hi, buddy. I work with him in Car and Hall as well, right? I'll put it in my child's education savings account. 8% return, protected by tax shelter. You damn sure I'll take that, right? But, I'm not in it for 8%, okay? I just told you, I sold a 22% performing note. The ladies are not here. They're out celebrating, I guess, right? Natasha will tell you some of her returns. So we're making north, it just depends. But you're getting paid for the work, right? If you're going to go renovate, Brenda and Sal, two of my clients who are actually in Texas right now, looking at notes they bought, last time they did something in Minnesota, they walked away with 90% profit. Okay? $60,000 they made, and they invested $50,000. So a little more than that. A total of $58,000, and they walked away with $61,000 after all expenses.
And I remember sitting down in the office with you, where you're like, I got to train you not to think like a flipper and think like a note investor, because I'm like, that property is crap. I don't want that thing. And she's like, you're not losing on this deal. Like, look at the deal, So, and it's funny because we've done I'm investing with Natasha on a couple of these, and a couple of them are starting to work out, and a couple of them are getting foreclosed on, and there's one that looks like a mess. But I'm like looking at the deal, and I'm going, I still don't see, even if we have a full rehab, how we would lose money on it.
So I was going to say, you are the one that's got me up at night. I'm annoyed. I'm like, it's an old house. He doesn't see how he can't make money. I told Natasha, I was like, I will buy that house from you today.
Well, no, that's why I did the math for Natasha, and I was like, she was like, I'm sorry if we lose this money. I'll make sure that we get it back on the next one. And I'm like looking at it, going, we're not losing money on this. Like, look at the comps and look at the rehab. Do the math. If I do the math the way I normally do on my flips, we're killing it. We're making like double profit. So I'm like, hey, I don't care.
The house next door to you is sold sold for 200, I think.
It's actually, because that's one thing about the notes is that sometimes the worst case scenario, which is you have to foreclose and take the house, ends up being your best case scenario from a profit standpoint, right? Because some of these notes that you can get, that you can create a tremendous amount of profit by adding value to it. Ellis, go ahead.
Sometimes the worst case scenario is that they pay you.
Yeah, exactly right. They pay on time when they're supposed to.
You're just like, oh, great, I'm getting this yield. Oh, wonderful. So, right. So, the old rule of happy if they pay, happy if they don't. Right? So you have to be able to say, okay, with either one of this range, am I okay with what happens?
Right. Yeah, go ahead, Jeff.
Are you buying mostly residential notes or other notes too?
That's very interesting because as I told my son, I said, son, he's 9, I said, they should have never let me into this game, okay? Because literally, I just taught, here's a quick story, my cousin's girlfriend was getting a lot of calls from a debt collector for credit cards. I said, give him the phone and tell him, kid you not, he bought $12,000 worth of debt, stopped the phone calls to his girlfriend for $3,000 and just told her to pay me back as you can. So, do I buy other debt? Yes, I do now. I'm actually trying to consider student loans, so I got to figure that out. But I mean, unsecured debt, everything. When you realize how much these banks pay for this stuff, you will get sick to your stomach, and that's what most of you guys don't understand. You're coming in trying to get a fair deal. Oh, I want to offer them this. Stop thinking. Well, the bank might be into this. Stop thinking. I just told you, they're in it. Nothing. Okay, and it's hard for you to understand, but I mean that with every word. So you have to have the guts to put an offer. Now, they're not going to just give it to you for free, right? But a respectable offer, once you learn what that is, you'll make some good money.
But are you buying like commercial real estate notes?
Commercial real estate? Heck, I'll get one a debt on a boat. You tell me, your child, do you have any debt on your kid? I'm in it now.
I mean, because all it is a note. It's a promissory note.
Write a promissory note, sign that thing. I might make you notarize it, and we're good.
Right, secure.
But even unsecured, right? I don't know if you guys go to this paper source. There's a gentleman, financial forensics, okay? But I was stuck too. I was like, how in the world do you buy stuff unsecured? I sit down in this guy's office for 10 minutes. There are people who literally know how to find money, like nobody's business. So he sat me down and showed me how he could find money anywhere from anybody. Secured or not, you just have to get the person to go and find the money.
It's also what you pay for the note, right? Like if
everything's about price.
Everything's about price.
As a broker,
so let's talk about that. And I know you mentioned there's some notes at par and everything else, but Ellis, talk about the differences in pricing on non-performing notes versus performing notes right now in the cycle, because I know that was a lot different 4 or 5 years ago.
Depends on the market too, right?
It really depends. I haven't really been buying institutional paper because I don't think you're being compensated for the risk, unless you have a sizable operation like it sounds like Jasmine has, where you're going to do a lot of this due diligence. I've found much more success buying private notes because I'm a smaller operation. So the pricing, it's kind of can be all over the board. When I'm buying non-performing notes, I definitely want to be in the higher level of return, 30, 40%. But there's no way to predict that, right? So, but you want to say, okay, there's a possibility I could make that. But the number one thing is I look at is, okay, worst case scenario, am I happy if I get this property back? Okay, if I can check that box, good. Am I happy if they make the payments? And I check off that box.
And when you say 30 or 40%, explain to them what that means. Like you're buying it at a price.
I'm buying it at a price where that once I get this thing performing again or it gets paid off, when I do all my calculations, I've made 30% annualized on that piece of paper.
And so, I think it's important to understand, that's an active return. You're working for that return. There's a big difference between active returns and passive returns.
Yeah, I could definitely identify with Jasmine when people say, well, can I get it's not like you go into the note supermarket and say, oh, the 22% return notes are in aisle 5. No, it's not. It doesn't work that way.
And really,
you have to create them, you have to find them, you have to work them.
And when you have as much experience in the relationship base with the capital investors over time like this, I raise capital from my investors at 6 to 10% flat rates, just because I'm always going to protect them and I put my money in second position to theirs always in those types of deals. But, that's a very passive return. The active returns, that's where the real upside potential is, but that's where the learning comes in. And guaranteed, you guys probably lost money in the beginning on some of these notes to learn the hard lessons like, hey, the title totally destroyed you on this one and you just lost your shirt on it, or it was close and you lost all the profit that you were going to make. Or something like that. So I'll let you go.
Yeah. What was the question? They don't even know the question anymore.
Yeah, it's all
for Christ's sakes.
No, I mean, I was just commenting on the passive versus active stuff, and then Ellis's returns are the 30-40%. That's because he's putting labor into this stuff to get that done.
So on the passive stuff or the performing stuff, you're looking at buying it at par, which is basically the price that the loan is at, and either some kind of discount beyond that or below that based on the condition of the note, right?
I rarely will buy at par anything. Occasionally, I'll do some notes where they're low LTV performing notes, and I'll throw a couple of those in the IRA and then the kids funds and stuff like that. But rarely will I buy something at par.
Yeah, those. So, like he mentioned, your pricing can be all over the place, right? Based on numerous things, right? And this is kind of why I love this industry. It reminds me of the stock market. There's so many moving pieces, right? And your deal depends upon who you're talking to, right? And so, first and foremost, he's 100% correct. If you don't want to pay par, then you stay out of California, because there's a lot of international money chasing it, and they're going to pay it, period, amen, and they want it. Their strategy is to buy it, and like you said, put it in that thing and hold it, right? Generational wealth. And so I rarely pay, and it's not for everyone in my group. Some people will say, hey, here's some par notes for you. The rest of the guys are further away from the Mississippi, I like to say, the better your pricing gets, right? So then after that, then it's about who your seller is, right? Because you've got to understand people own notes in different ways. Some of these guys are selling you notes that they already bought. They bought a big pool from somebody, so clearly they're marking it up and giving it to you. It's in their inventory. It's inventory. It's the store, okay? Some people are brokers. Myself, I'm a broker. Some other people are brokers for a lot of individual people, right? I broker specifically with banks and hedge funds, right? And so when you get into that world, it's different. When you're doing with individuals, he's 100% correct. It's about what you're talking about, you and me. What are you doing? What's your value, right? Banks, I love them because they're just banks. They don't care. They just want to get the stuff going. Get it off my desk. Get it off my desk. And so, one, you can start to get a pattern for who and what their pricing is, but everyone's going to have their separate pricing, okay? So Harbor's not going to price like Ocwen, and Ocwen's not going to price like Vision. You've got to get to know your seller. Lastly, I want to tell you, the best thing, and I know it's escaping you guys, but I know it is. I told you the banks are in it for almost zilch, but you're not getting it, right? Because you're asking me about pricing. Do you understand? So pricing is about your relationships. That's why I love this. So when you start in notes, don't roll in saying, I want 10 cents on the dollar. You're not getting it. Who are you? How do I know you're not going to hurt yourself? How do I know you're not a scammer? I'm giving you social security numbers, right? I had to earn my way here. Every year that I'm doing this, the more volume I get from my sellers, my pricing goes where? That's why I'm in the note business. Because the better your relationship is, the better pricing you're going to get. Because they are not in it for that much.
Yeah.
Jed.
Yes, sir.
Unsecured debt. So how do you protect yourself? Do you look at the borrower who may not be performing, but he's got a lot of equity, or she's got a lot of equity in her primary residence, and therefore you know that you're going to get something from her?
So unsecured,
not going to declare bankruptcy.
Unsecured debt, totally different game. You're all about the person. Okay, when I'm buying a non-performing note, I could care less about the person. I'm not asking for a credit score. I love people. Hey, what's their credit score? Who cares? They haven't paid in 10 years. I'll tell you what the credit score is. Okay. So,
but if somebody's got unsecured debt and they have nothing, you're not going to buy that.
Right, that's less likely. But you need to know what nothing looks like, because that's when the financial forensic guy comes in. Because a lot of people know how to make it look like they got nothing. This guy finds it.
So you're finding something that you can take a shot at. So, Brett, let's talk about like when you're in a note, either you bought a non-performing note in their world, or you're in a note that's a performing note that goes bad. What's the process look like of how you solve when all of a sudden paper goes distress and non-payment? What happens as part of the contract, as part of the note?
Well, unlike you guys, I don't service my debt either. So who I originate my loans through, I pay them a 0.5% fee. Sometimes it's 0.25% to service my notes. All that means is they collect the monthly payment, they distribute it to me, they make sure the property taxes are always paid, they make sure the insurance is always paid, and they serve notices to the customer. But I also get a statement every month, so I make sure. We've had notes, we've had deals go sideways. We had one guy who was incredibly aggressive after paying on a deal for about 5 years. I was in third position again. It was a $150,000 third that I owned in Santa Monica on a triplex. I was at about the first and the second was 30 grand, and the first was like 300 grand. So I was at like 30 LTV, and the guy came to us after the property values were distressed, and he came to us requesting for a $100,000 markdown on his note. Stopped making payments. Came up with this whole distress scene. Started declaring fraud that and I called his bluff, but I did have to go. Go through foreclosure. They stopped making. We finally got him to admit, by the way, that what he was doing was Wells Fargo, who was in first position, he was cramming them down, and they agreed to take to take his $300,000 plus note to mark it down to like 200 grand and give a 1% interest rate, because he got them to believe that the property was upside down. A triplex in Santa Monica.
You're like, sweet, you just saved me and made me more protected.
But the only way they would do it is if he got rid of the third.
But now you know why I love working with the big banks. They don't know anything. Wells Fargo's in New York not giving a damn about it. I'll be honest with you.
They didn't care.
And they're like, what? Huh? As long as you get the right person on the phone, you got yourself a deal. It's a banker, right?
So you have deals go bad, and I had one go bad in Long Beach, the one that and I made the biggest mistake I ever made since I've been in this business, and I went and knocked on the door. And I saw the woman and her family that I was about to take her house back. And from that point forward, I've never once met somebody I've lent them money to. So
it's a hardening business, kicking tenants out, kicking people out when things happen.
Right. I want to give one other story, by the way. Restructuring debt, I've restructured notes. I had this one guy, he sent in this letter how he lost a leg and he lost his job and his income went 50%, and then his wife was and it was a heart-wrenching story. And they asked for a 1% discount. They were at 12. They asked if I would do 11. And I'm like, absolutely. Mm-hmm. I sent him a loan mod for 1 year, and they paid for a year, and then they sent me another letter telling me that I was usurious because I was charging him 11. I go, you asked for a discount, and I gave it to you without even...
They got an attorney.
Right. Yeah.
They sold the house and paid me off.
Yeah. All right, so that's one way, Ellis, that you can go through. A note goes bad, you can restructure it, you can modify it. Let's just say you can't and you have to foreclose. What does that look like? What's the process look like in having to go through that?
It'll vary state to state, but in California, it starts with what they call a notice of default, and you have to wait till they're delinquent for 90 days before you can file that. And then if they still don't respond and make any payments, then it goes to what's called a notice of trustee sale. And then they give them 21 days to cure that. And if that doesn't happen, it goes to the courthouse steps, and highest bidder will buy that note. And it's...
Do you get the property then, or do you have to go buy the note?
No. That's one of the myths of note investing, is that people say, well, you'll just get the property back. You're never guaranteed that. You're the lender. You have to bid against everybody else. So you have a credit bid that says, okay, I lent $270,000 on this $500,000 house. Somebody could bid $271,000. Then now they own the note, and you get paid. You're entitled to the debt, legal fees, and some other miscellaneous fees that are statutorily allowed. But you can't just say, hey, I'm going to just take this property back and circumvent the whole foreclosure process.
And let me clarify, because terms are important, right? So the foreclosure process, you're not going to get the note at the end. You kept saying no. You're actually going to get the property. You're going to get a sheriff's deed.
You
get a sheriff's deed, right?
You get a trustee's deed.
You get the deed. Right, but you're going to get the deed to it at the end of the sale, right? So if you're there, you're going to get a deed in the end, right? So that is going to extinguish the note. So there's going to be no more promissory note at the end. So that's what's important. When we say note, that means an actual secured note. The foreclosure process wipes that note out, right? So now it's just a deed. And the reason I want to bring that up is because one of my favorite things of buying non-performing note is you buy a non-performing note at a non-performing note price. Then since the big banks, don't know what the left arm is and what the right arm is doing, you get a file in the mail. Typically your files are this big. But then I get a file this big. And I'm like, what's going on? You know what happened? Foreclosure happened already. So all that other paperwork is null and void. All I have is the deed. The sheriff's deed, the trust deed, whatever you want to call it. I'm excited because now I own this at a lower price. I don't have to put in a foreclosure cost. I don't have to do any of that. Money, right? So we just bought an REO at a note price.
And Alice, you're talking about California, which is a non-judicial state. Jasmine, talk about what happens in a judicial state if you want to try to foreclose.
Yeah, I mean, you guys get a little afraid about that, but let me be honest, that's the least of your worries, because here's the deal.
But it's different. It's a different process than California.
It's just a process. That's why I want you guys to understand, right? It's just a process. As a bank, you need to be ready for time. Time is your biggest Achilles heel. So whether it's a long process, short process, just brace yourself for a process. If it's shorter, then bonus, right? And so that's how I mentally prepare myself for it. But a non-judicial state should be a shorter process, but it's not guaranteed. That's why I tell you, don't even get up here saying, I want a non-judicial state, and I'm going to tell you to leave my office, because that doesn't mean anything. You can buy a non-judicial paper, and because in Texas, you buy any pieces of paper from Auckland, it doesn't matter. It all has to go through foreclosure because they're in trouble. All of it. You go in the long route.
Go through.
So there goes that rule, doesn't it? Right out the window.
Go through a judicial court process.
There's a lot of states that are both, right? Judicial and non-judicial, depending.
It depends, again, who you bought the paper from, okay? What state you're in, right? If you have a contract for deed, guess what? You don't have to go through a foreclosure. It's called a contract, a forfeiture. So there's another loophole that I love taking advantage of. That's why I love contract for deeds, right? The heck with a foreclosure and 24 days and notice of default. So
this basically turns it into a lease and you evict, right? And a contract for deed.
100%. It's just like an installment contract. So there's so many different ways to work this paper that you should not limit yourself saying, I only want to work in judicial because it might take so long. You could get a non-judicial piece of paper and be forced to go judicial and vice versa.
Is there any specific states that you think you probably want to stay out of just because of the laws in those states make it very difficult? Like what states would you recommend staying out of?
New York, New Jersey, Florida, right? Florida's sexy as ever, but guess what? It goes up and falls quicker than ever, so you don't have that safety as a lender. And also, it's going to cost you a minimum of $4,000 to $5,000 just to do the foreclosure, right? So it's an expensive foreclosure process. And it's not lender friendly. It could take you 2 to 3 years. I bought a note there 2 years ago. I finally got a foreclosure sale date. 2 years into it, promise you, I kid you not, the day of my foreclosure sale date, what happened? The hurricane. I still don't have another foreclosure sale.
We have the same note, the same thing, and they pushed our case off by 6 months. And then we came to the trial again, and the borrower claimed that she never got the money that we were been foreclosing on for a year and a half. And now we're back in court and doing depositions and everything else.
You're going to deal with this time?
Oh, we're in a perfect shape on it.
Right?
Yeah, we got time.
There you go.
So, I mean, a lot of the people here. Actually, let's answer the question first, and we'll go to the next topic.
Yeah. What if your borrower files bankruptcy? How does that happen?
Good information.
It's my favorite. I love bankruptcy. I know you think I'm crazy. I know that's why I put the hat on. I love bankruptcy. Okay, let me tell you why. Anybody want to know why? Show of hands. Just come on, entertain me. Well, for one, as a bank, your biggest problem is RPC, and that's what we call right person contact. You cannot foreclose on anyone in America without letting them know, no matter what state it is. Okay? So, when someone files bankruptcy, this is like, hey, I'm over here, this is who I am, but you can't talk to me, you only can talk to my attorney. I'm like, woo! Because he just told you, I don't want to talk to you in the first place. I didn't want to know your name. I didn't want to see your blue eyes. Okay? So look on my attorney and say, attorney, will you call her attorney and figure out what's going to happen and call me when you're done? I'm going to the beach. That's why I love bankruptcies. Also, bankruptcies typically trade for premiums because there are literally funds out there who just specialize in bankruptcies. Networking is key. You can actually go out there, and I've many times said, what type of paper do you buy? We only buy bankruptcies. I'm like, cha-ching. So when I have a piece of paper, if the thing turns bankruptcy, you know what I do, and I don't want to deal with it? Hello? I have a note. You want to buy it? Middle of it. You can trade notes at any point, and nobody gets a phone call about it. You understand? It's beautiful.
Awesome. So who here is interested in, this is supposed to be Notes lifeblood of every deal, right? And I know a lot of you guys are interested in the non-performing stuff and learning how to, do notes and make money off of that aspect. Who's here interested in learning how to raise capital for their deals, their active deals and things like that? Okay, we got one in the back, we got a couple of, okay, cool. So, I mean, notes play right into that, right? And all of you guys, either raise capital or work with capital sources in different ways. And in my opinion, a lot of it is around about educating those capital sources and things like that, and knowing what due diligence steps you do to teach them. So, Brett, how do you work with different investors that have capital sources and, on your private side and things like that? On the traditional side, I would assume it's Fannie Freddie, pretty easy, simplistic stuff. But on the non-traditional side, what is like some of the limitations and the bread and butter that some of your capital investors like doing?
I'll give you some examples of some examples of typical deals that we fund with private money. Here's from the most simple. is someone's primary residence. They're still sitting on 6.5% interest rate because they could never refi. The realtor, still got his Lamborghini, but he's got $100,000 in credit cards and he owes, $50,000 on his second. But he's got all this equity in his home, but because he has a 620 credit score, he can't refi. He still makes good money, but he's leveraged to the hilt and he's buying his girlfriend, expensive vacations. So we can go in and we can give him a second trust deed, let's say $200,000. We'll pay off his credit card, we'll pay off his second, and he had no money in the bank either, even though he makes a lot of money. And we put $60,000, $70,000 in the bank, and we season it. 90 days later, we have a guy with a 760 credit score, no debt, and $60,000 in the bank, and I can refinance him into his 4.75% rate. So that's a common tool that most people would not use, but it's super simple.
Keeping up with the Benjamins, spending money.
Exit for them, or they're in and out, and it's clean. Hopefully they learn their lesson, but not usually. Another one example is I have a client. They're from Alaska. They flew down here. They wrote an offer. They got the first one. So lucky. It's out in the valley. They paid $860,000 for it. It's a single family. It's an unusual property. It's a single family, and it has a church on it. But the city already told the previous owner, and they gave him all the pseudo entitlements, that's not true entitlements, that it can be a duplex and it's partially under construction, it's vacant. Perfect A credit borrower, they make a ton of money, they own plenty of rental property, but no lender is going to touch this property under half construction with entitlement issues. So I'm lending them a quick, we're going to do a small first trust deed for them. They're going to pay they had plenty of money, but so it's a small first trust deed. They're going to do the rehab, they're going to finish it, they'll complete it as a duplex, and in about 6 months to 9 months, we'll roll them into a conventional loan. So that's a typical use. Any trustee investor would love to invest in that. It's going to be a 50% LTV deal, at 8 3/4, right?
And that's exactly the type of thing that I'm talking about when you're trying to raise capital from private investors. Being able to show them, hey, here's my comps and my market value. Here's my rehab estimate. Here's everything about the deal in a quick summary bullet point format so they can understand it. And then here's how you're protected with the 50% loan to value or 60% loan to value, or here's the operator's bio and backup and their background check and things like that. Putting that kind of package together on your deal makes it so that it's almost a no-brainer as long as you can explain it and as long as they have that comfort with you to be able to raise that capital. And I think that's important to understand. You got clients that are, a lot of these hard money deals are, he's able to do these because he's there able to take down a deal that's a little weird, that's outside of the box. And so as a private lender and a hard money lender, being able to do those things are hugely valuable. And raising the capital for that gives you all the power in the world. So you as an investor, it's imperative that you learn the steps to teach your investors so that you can go through and raise that money from them. But this is hours of their life, so don't lose it. And take it out on your credit cards to pay them back if you have to. Do all those types of different stupid things and protect your investor every way you can. Jasmine, how do you go about raising capital for your deals and things like that?
Chime in there, so thanks. So what he's saying is 100% true. One, if you're having problems raising money, either you don't have a good deal. I've never seen a good deal go unfunded. Okay, and so that's why I love notes, because you're getting in so low, it's either the person doesn't understand or you need to walk away from them, right? And so you either need to explain further or you got to get away from the table, right? And so when the numbers look that good, that's the first thing about me raising money. So just like you said, putting together a package that I can articulate what the spread is, why it is. And especially with the notes, I'm looking at spread so high, like when I'm sitting down with those people in Texas and I'm saying, hey, we might make a 60% return, right? And they end up making 90. It's like, I'm making 60. What if this happens? Well, we're not going to go, what if we profit in half? Are you still okay with that, right? So when you're talking about profit margins this high, it's easier to find money because you have cushion for mistakes, right? But the most instrumental thing, other than me knowing what I know about notes, because I didn't always know, was working with people like Jeff. I got to tell you again, with clear just conviction that you direct IRA, right? Who else do I work with? Quest IRA out of Texas, Quincy. These are really good friends of mine. And so you've got to build your relationships, because when it was time for me to sit down, and I was only 2 years into the note game, okay, at no point did I say to these guys, hey, Mr. Multimillionaire, you want to give me some money to do a note? No. What can I do? Let's use your self-directed IRA money. What I did was I said, hey, Karin, hey, Jeff, you guys mind meeting with me with one of my clients? They always said yes. They always have. Is that true? You have open door policy over there, right? You guys, if they want to sit with a client, yeah. That's one of my tributes to success, you guys, right? So I would have one of my clients, and I say, I'm not the expert on self-directed IRA funds. But if you like, I call a meeting, and the fact that Karin, the president of the company, or Jeff would sit down with me, they already, boom, right? Sit down, I tell them what I know, let the expert take it from there. So what I want to say to you, if you're looking to raise money, don't try to know everything. That's the biggest rookie move ever. Okay? Know what you know, and then find the other people to support you.
Absolutely. Ellis, you do things a little differently with the private, the private notes for the most part. Jasmine buys a lot of institutional and also private as well, but I think you focus more on the individual investors. And I'm going to tell everybody a little secret Ellis told me, because I know 1% of you guys will actually do it. But to go and to market for notes, to actually go through and start to find all the trust deeds in a specific area that you want from the private notes, take out all the banks and start mailing them to see if they want to not only sell their note, but if they don't, and you see, what interest rate are you getting? They may be lenders then to lend you money in that case too. So it was kind of an interesting play from that side. But on the individual scale, it's probably a little easier. You're dealing probably a lot of Midwest, as well as I would assume some California. How do you go about doing that? Do you structure it with joint ventures or with debt? How do you structure that type of, when you're raising the capital for these deals, or you don't have it all yourself to be able to, do you split profits with them? Do you do debt or some of both, or does it depend on the deal?
It really depends on the deal. One of the structures we used a lot in the beginning was we had a agreed upon split, and then we would pay them a preferred return while they're waiting. So one of the things we wanted to do is, what I found is really dangerous in this game is when you start throwing out high numbers for rate of return, because then the expectation is, hey, we didn't make 50% on this one, what's wrong? I never want to be in that conversation. So I would say, hey, if I paid you a preferred rate of 5% and then we split the profit after it's done, is that going to be okay with you? And rarely will I take on what I call the high roller type of investor, because those type of people come and go. They're way too speculative for me. I would rather be the hero where I give a surprise rather than, hey, you didn't perform. This guy over here is promising me 40. I've seen so many people lose on the promise of higher returns when, if you just you play it close to your vest and you play it smart, and then you'll get a nice surprise every now and then.
And it's funny because a lot of people think when you go tell them those high returns, they're like, right. Oh, with the inexperienced people are like, it's more risky. You're like,
yeah. I've had
not
people,
more risky because of the higher return.
Yeah, I remember I offered this one investor a 7% preferred return, which I thought was really high, but then she said, oh, this other person's going to give me 12. I said, well, go ahead and take it. I get a call about 3 weeks later and says, shouldn't I be getting some sort of paperwork behind this? And I'm like, wait, you didn't get a deed of trust, you didn't get any, and I ended up having to help bail her out, because what it was basically a Ponzi scheme.
Yeah. Sure.
And I felt horrible, but I said, those are the things you have to do before the money leaves your hands. You have to know how to protect yourself.
And that's the thing. There's people out there that will lend you the money with no paperwork. There are people that will have no idea who you are and just lend you the money. And you, as an investor, should take it upon yourselves to educate them on the right way to do it, because they will get screwed later. If they go and do it with you and everything's fine and you didn't teach them the right way, or you didn't teach them about the paperwork or what they should have, then later on they're going to do that with somebody else that is going to screw them, and that's going to happen. It happens all the time.
Yeah, and I just want to say that the person you work with is just lucky to have you, because I tell people this is a B2B, not business to business, bank to bank, right? There's no consumer protection agency, right? This was the closest she was going to get. So, you're going to, especially with notes, you got to wire the entire thing. Again, there's no escrow, there's no deposits. Whenever you're going to pay for it, and when it comes to wire, you wire the entire amount. So you should get your dot your I's and cross your T's 100%.
Which is an advantage and a disadvantage as well, because you don't have an escrow company looking over your file, making sure it's structured right. Some of that flexibility also provides some risk if you don't know what you're doing. Yeah.
Is there any requirement of being any kind of a qualified investor to buy notes?
I have one. But no, I mean, that's why half of these people get taken, right? Because you can buy from a private investor, you can walk down the street and meet somebody, you can, so for me, I have a vetting form, right? And that's why the banks love it.
They do have an accreditation requirement now for a lot of people that invest in trust deeds.
And I think you need to be careful when you're buying non-performing paper or you're raising money from investors. There are some crazy ass people with money that you don't want to do business with. There really are. Even if they have capital for your deal, you don't want to do it with certain people because they're crazy.
And
so
guys,
be careful. Vet them that way too.
And also, just be honest, right? It doesn't really. You can have an accredited investor criteria, but it's not going to stop you from getting taken advantage of, right? So we really have to be with someone, build a relationship, and then know that what you have been trained to ask for is what you need to get. Because otherwise, you could fill out all the paperwork you want. Doesn't mean the guy's not going to Tahiti tomorrow with your money, right?
Who here is a fix and flipper as well? Anyone do any fixing and flipping back here? So we have a house that we are working on right now. The individual homeowner has a bunch of equity in it, but they're cash poor. It's up against foreclosure, and we're trying to find a way to help them save the house. We have an investor who's willing to come in, basically put some money in to stall the foreclosure, and then do a seller finance note back where he can then go in, fix up the property, and resell it. And the guy was like, well, what am I going to have a note for? Would you ever want to buy a seller finance note on a piece of property like that?
Not if they're in foreclosure, because
they won't be in foreclosure. It's part of the money going into the deal.
They're notice of default now.
Notice of default now.
I would not lend him money.
Investor's going to go in.
He's asking for trouble.
No, pay off the notes, take care of the foreclosure, right. Own the property legal, and then have a note back.
No, 100%. To me, first of all, I would do that.
Yes.
100%.
Yes.
Just so you know. My only problem with that is that it was a complicated way. I'd like to just call the bank, take possession of the note at a discount, and call him and say, what do you want to do?
Right.
So that's the best way, right? So you get a hold of the bank, buy it at a discount, and now you're in position. Because what you're doing right now is just trying to figure out how to deal with the bank.
Well, and part of the point I'm trying to make here, and you guys maybe talk about some other alternative ways of using debt, right? That's a way of being creative, knowing that there's debt to get yourself into a deal, and then teaching people about debt along the way. If they don't want to be note holders, help them find other people that are willing to buy the debt.
But just do it the right way. It all leads back to doing it the right way, season. Because in that scenario, I've had people do it and not have the right paperwork, so they end up just paying off someone else's note, their house, and now they're like, what are you, no title, you just paid off someone's debt. And me as a lender, I'm happy, but you don't. What do? You got to sleep on a guy's couch. Right.
So we've got about 10 minutes left, and we're going to be wrapping up here. Let's talk about some things like technology, and more importantly, I know, Matt, you mentioned Dodd-Frank before. I know there's been a lot of legislation since the last crash. Brett, talk about like how that technology and how, more importantly, some of this legislation is changing the industry, changing the notes. It's been the wild, wild west for a long time. I think it's starting to get a little more structure to it. Talk about how technology and some of the legal changes are changing the note industry.
Well, for many years prior to Dodd-Frank and Financial Reform Act, the only criteria we cared about when lending so-called hard money was the loan to value. So primary residence, investment properties, apartment buildings, land, it was all the same. As long as you have equity, we'll lend you money. As soon as the Financial Reform Act came out, part of the Dodd-Frank Act has a thing called ATR, ability to repay, and it applies to all owner-occupied properties. So if you have a property that it's worth $1 million and you only owe $200 on it, an investor could care less if you make your payment, because I'd be happy to take your property back or sell it at, So now Dodd-Frank says, nope, you can't lend to them. So you could have a $3 million house in the hills, and you're out of money, and you have bad credit, and we can't lend you $100,000 against your house because you must show the ability to repay. So it totally cleared out the hard money lending world as far as lending, with the exception of us. And I say us, I don't mean me. It's a company that I do a lot of my lending through. They're doing about $40 million a month in primary residence hard money deals. And there's the ability to repay by Dodd-Frank is just called the ability to repay. Banks, Wells Fargo, BofA, all the big banks have their definition of ability to repay: W-2s, pay stubs, tax returns. But the hard money lenders have their own interpretation because Dodd-Frank doesn't interpret it other than you have to be able to defend your ability to repay. So they can call the ability to repay an exit of their home by selling it, or maybe they're going to rent out some rooms, or maybe they have some assets in the bank, or maybe they have some money coming somewhere else. So their definition is loose on the ability to repay. It must meet the litmus test. It could be one pay stub. Oh, you make 30 grand a month? Great, we'll lend it to you. A bank or anyone else isn't going to touch them. So Dodd-Frank put a huge monkey wrench, and about 95% of all hard money companies, maybe more, left owner-occupied. So when you hear all these guys, you have equity, we'll lend you money, they're all talking about investor properties only.
Jazz, I know, like, beyond just the federal legislation, you have all these different states that all have their own separate rules as well. So how do you navigate that when you're buying a portfolio of notes that's all around the country?
We have teams, right? And so I really can't tell you about relationships anymore, right? Relationships. So basically, I have one guy in Kentucky. My Kentucky attorney is the same one for Auckland. Okay, so I like him. I patronize him. I don't want him to go anywhere. So all my Kentucky and Indiana paper goes to that guy, right? So he shuffles through it and makes sure it's clean before I buy it, and then on the back end, he helps me work through it on the, get through it. And again, he does this for Auckland, so I'm not worried about whether he does this right or not, right? So I just try to align myself with professionals who are going to help me take it down, One thing I want to say about, at least on my end, the secondary market of the industry, is that we're really cushioned, right? We really don't have much of that outside noise bothering us, right? Dodd-Frank, every time he loosens it, I make more money, right? Every time, the fact that they're now going to allow more smaller banks inside, to do originating, that's only going to make my phone, it already started ringing. A lot of these smaller banks now want to know who they're going to sell their distressed assets to because they don't want to work them, right? And so it's going to just give us more inventory, right? And so low interest rate, high interest rates on the secondary market doesn't matter to me. The only thing that matters to me is what I pay for it. What's going on outside doesn't matter because this guy wants to keep his house, right? Brent, you want to stay in your house. So when it comes to me, it's come to Jesus talk. That's it. And so that's really.
Do you do your own workouts?
Yes and no, right? So what I do is I work hand in hand with the services. I let them do all the paperwork, but then I have my local attorneys, and then I have local, what we call boots on the ground, take care of it. The difference between me and the bigger banks is literally just the fact that I will, not me, but I will have someone, a professional, talk to them and say, hey, what's going on, right? And so for us, it goes straight to the attorney, and at the same time, the attorney's the local attorney, which is different, right? You're going to get a letter from the servicer all the time. That doesn't get anybody's attention. We've been getting that for 10 years, right? When they get a letter from a local attorney, all of a sudden, they come out of the foxhole, right? So that's my first step. And then after that, I always send a local guy, Craigslist, send somebody around $50, somebody that probably they've even seen already. How can it go? Your bank just contacted me. You will be amazed at how far you can get when you have a local person knock on the door and just find out what's going on. These people are scared. They, if they can, and I'm helping them if they can, because we buy it so low. It's like, what can you do? If you can't do anything, then we help you get out. Right?
We had door knockers go around and literally would have a cell phone, a prepaid cell phone. They would give them the cell phone, hit send, and say, "Hey, call the lender." Like sometimes something creative like that, because that's the hard part. Sometimes is just finding who these people are and getting them to talk to you.
Not to be scared and just talk to them.
Just talk to them. We want to help you. We want to help save your house. How do we keep in your house?
Some of these guys for 10 years, all they want to do is make a payment, and the banks won't do it because these bigger banks. They don't care about the house is $100,000. As soon as you go 6 months behind, that goes into an abyss. And these people can try to send payments, and they'll get sent back to them, right? So some of these guys are really unfortunate. It's like, I've been trying to send a payment for 8 years. It's like, are you kidding me? No. And then you get money. Mm-hmm. It's rare, but literally this is what they run into because no one cares once $100,000 is completed.
Alice, what about how have some of these changes? How's that affected your business? Because you've been doing this for a while.
Yeah.
And I'm interested to hear because Matt also mentioned the fact that you're maybe using technology to find loans in a way that's different than maybe you couldn't 10 years ago.
Yeah, I mean the data that's available now is just incredible. You could find amazing lists that things you could never even dream up. I've got a long list of all these private loans that are in my area that I work. So I that's how I use technology. I use a lot of virtual assistants to scrape a lot of data and things like that. But as far as Dodd-Frank, it changed my business because there's a lot of liability and risk that is involved whenever you're dealing with an owner-occupant. So although I can see how Brett says, well, you can define your criteria however you want. True, but for a small operator like me, I'm not interested in ending up in court and going to a judge and proving my formula. So I just chose not to go in that game, and I stick with stuff that I understand. There's still plenty of loans that I could do where, if there is a title issue, like if there's a probate or something, somebody died, they're not on title, the deceased is title on the property, the beneficiaries don't have title of the property, but they need money to fix up the property, attorney fees, things like that. There's plenty of opportunities to do that.
That's pretty lucrative too, right? You get really high returns doing that, right?
It can be.
Because you can get the loan put into the estate, I believe, right?
There's lots of plays with that. One of my mentors is one of the biggest probate lenders in California. So he's taught me a lot about the different types of paper that are available to be created and also acquired. So that, and that's what I love about this game is that just because there's Dodd-Frank doesn't mean there aren't any deals left. It's just you make your choices and you shift. But it did change a lot because I used to do what were called Section 32 loans. Somebody's in foreclosure, I'll give them a loan so that they can pay off the arrears, and then now I have this relationship because when they get into default again, which happens quite a bit, I'm gonna know before anybody else, and that was kind of my game plan way back when they weren't as onerous with the regulations. Now there's a lot of liability, personal liability with these loans to homeowners.
And I think, a lot of people are talking about seconds up here and thirds. One of the most important things other than loan to value and your protection of the property is knowing that the first is getting paid. And, whenever I do a second on a hard money loan or something, I'm like, give me the first contact information, show me the payment history, and I want to see the payment being made every single month. Yep. These are the types of things that don't get wiped out from your first if you're in second. It's pretty important to understand those types of concepts. It's not easy either sometimes. So. Yeah. That being said, I think we're good for tonight, right? So what's going to happen is we will, right in this hallway, right around this wall, you'll go right this way, and there's a back door with the stairways. Go right downstairs and make a left, and then another left where the coffee shop is. So out here to the left, make a left, and another left, and North Italia will be, straight ahead. So we'll all be down there networking. We got to clear out of here pretty much right away just because of the people have to clean the space. So thank all the speakers very much, you guys, and feel free to see us next month. Thank you guys very much.